Digital Assets for Investors. Chapter 12, Risk Management. Section 1, Position Sizing. Position sizing is the step that turns an idea into an actual trade size. It answers the practical question of how many shares, coins, contracts, or units you can hold while keeping risk under control. The stop loss tells you where you plan to exit if you are wrong, but position size tells you how much money that mistake will cost. Those two decisions work together. If the stop is hit, the loss is not random, it is largely determined in advance by your size. That is why position sizing is one of the main tools for protecting an account from serious damage caused by any single trade. A useful point here is that the stop price can stay exactly the same while the total trade risk changes dramatically. If you buy at $10 and place a stop at $9, your risk per share is $1. With 1,000 00 shares, that trade risks about $1,000. With 100 shares, the same setup risks only about $100. Nothing about the trade idea changed except the size. This is why traders who focus only on entry and stop but ignore position size often take far more risk than they realize. Many investors use a simple rule: risk only a small percentage of account equity on any one trade. A common range is about 1 to 2%, though the right number depends on the strategy, the market, and your tolerance for losses. The purpose is not to avoid losing trades, because losses are unavoidable. The purpose is to make sure a losing streak does not knock you out of the game before your edge has time to work. This also means position size should adjust as your account changes. If equity falls, your risk budget per trade should usually fall with it, and if equity rises, your allowed size can increase gradually. Most position sizing calculations come from three inputs. First is account equity, which is the total value of the account. Second is the fraction of that account you are willing to risk on one trade. Third is the stop loss width, meaning the distance between your entry and your stop. Once you know those pieces, the formula is straightforward. Position size equals account equity times risk percentage divided by the dollar risk per unit. In plain language, you first decide how much you can afford to lose, then divide that loss budget by how much each share or unit could lose. Let's walk through a stock example using the fixed fractional method. Suppose the account is 50 real $0 and the risk rule is 1%, so the maximum allowed loss is $500. If the trade entry is $20 and the stop is 18. 50, the risk per share is 1. 50, the visiting 500 by 1. 50 gives 333 shares. Dividing 500 by 1. 50 gives 333. Because risk control matters more than perfect precision, you round down, not up. So the correct position is 333 shares, which keeps the trade within the planned loss limit. You can reach the same answer using percentages instead of dollar distance. In this example, the stop width is 1. 50 divided by the $20 entry price, which equals 75%. Your risk capital is still $500, so the allowed exposure is $500, so the allowed exposure is 500 divided by 0.0075, or about $6,666. Dividing that exposure by the $20 share price gives 33 shares. Rounded down, that is again 33 shares. This is helpful because it shows the method is consistent whether you think in dollars or percentages. Position sizing gets more complicated when the asset type changes. Spot assets often allow flexible unit sizes, but more volatile markets usually require smaller positions because each unit carries more risk. Low liquidity assets can also create hidden risk through slippage, where the actual exit is worse than your planned stop. Futures add another challenge because they use fixed contract sizes. Sometimes the minimum trade size is simply too large for your risk limit. In those cases, the trade idea may be valid, but the instrument is not suitable for your account size. Consider a futures example where the setup looks attractive, but the numbers do not fit. Imagine a 25 $00 account using a 2% risk rule, so the maximum loss allowed is $500. A crude oil trade entered at 75 with a stop at 73. 50 risks 1. 50 per barrel. A standard contract controls 19700 barrels, which means one contract risks $500. To stay within the $500 cap, you would need only 1/3 of a contract. Since standard contracts cannot be traded in that fraction, the trade does not fit the account. Good risk management sometimes means doing nothing. If the proper position size is smaller than the market allows, the cleanest answer may be to skip the trade. If a smaller contract or micro contract exists, that might solve the problem. Tightening the stop is only reasonable if it still fits the strategy and is not just an attempt to force the trade into your rules. What you do not want to do is override your own risk limit because the setup feels exciting. Discipline is part of the edge. To lock in the process, take one more practice example. A $100 account risking 1.5% allows a maximum loss of $1,500 if the entry is $45 and the stop is $42.30. The risk per share is $270. Dividing 1,500 by 270 gives 555, 55 shares, so the correct trade is 555. 55 shares, so the correct trade is 555. The common mistakes are simple but costly. Rounding up, ignoring that volatility may make the stop unrealistic, or forgetting that one trade exists inside a larger portfolio. Position sizing works best when it is precise, conservative, and connected to total portfolio risk. Section 2. Volatility management. Position sizing gave us a fixed risk framework, and volatility management adds a way to adapt that framework to changing market conditions. Volatility is simply the size of price swings, not whether price is going up or down. When volatility is high, price tends to move farther and faster, which means a normal fluctuation can become a meaningful loss. When volatility is lower, price behavior is usually steadier and stops can often be tighter. Because risk depends on how far price can move against you, position size should change as volatility changes. The goal is to keep your risk more consistent even when the market is not. If you keep position size fixed while volatility rises, risk often increases without you noticing. A calm market may allow a relatively tight stop, which supports a larger position for the same dollar risk. A volatile market usually needs a wider stop to avoid getting shaken out by normal noise. That wider stop means each share or unit now carries more risk. Unless size is reduced, total trade risk rises above plan. Volatility-based sizing is therefore about capital protection, not about predicting where price will go next. One practical tool for estimating volatility is ATR, or average true range. ATR measures how much an asset has been moving on average over a chosen period, often 14 days. It captures not only the daily high-low range, but also gaps between sessions, which makes it more useful than a simple intraday range. A higher ATR suggests bigger recent price movement, while a lower ATR suggests a quieter market. The look-back period should match your style. Shorter-term traders may want a shorter lens, while longer horizon investors may prefer something more stable. Using ATR for sizing follows a simple sequence. First, decide the maximum dollar amount you are willing to lose on the trade. Second, choose a stop rule, such as 1.5 times ATR or 2 times ATR, depending on the strategy. Third, convert ATR into a stop distance using that multiple. Then divide your dollar risk budget by the stop distance to find the number of units you can hold. As with any risk calculation, round down rather than up. That small act of caution keeps the trade inside the limit you chose. Here is a worked example. Suppose you have a $50 extra $000 account and risk 0, 5% per trade, which gives you a $250 risk budget. If ATR is 250 and your stop is set at 1.5 times ATR, the stop distance becomes 375. Dividing 250 by 375 gives 67 shares. To stay within the limit, you round down to 66 shares. The order of thinking matters. Define the risk first, then convert volatility into a stop, then calculate size. This framework becomes especially useful when market conditions change. If ATR rises from 250 to 400 and you still use a 1.5 ATR stop, the stop distance grows to $6. With the same $250 risk budget, position size becomes 250 divided by 6, or 41, 67 shares. Rounded down, that means 41 shares instead of 66. So even though the trade idea may be similar, each share now carries more risk than before. Shrinking the position keeps the dollars at risk from drifting higher as volatility expands. It is also important to know that not all volatility measures answer the same question. Historical volatility looks backward and summarizes how much an asset has actually moved in the past. Implied volatility looks forward in a different way because it is derived from option prices and reflects market expectations about future movement. For spot assets, stocks, and many trend or swing strategies, tools like ATR and historical volatility are often the most practical. For options, implied volatility matters a great deal because it affects premium levels. High implied volatility often means options are relatively expensive, even before you consider directional views. Volatility tools are helpful, but they should not be treated like autopilot. It usually makes more sense to review volatility on a schedule that fits your strategy, or after major news, rather than resizing positions on every small wiggle. It is also easy to confuse volatility with direction, but the two are different. A market can be volatile and still trend upward, or quiet and still decline. ATR can also wag sudden shocks because it is based on recent history rather than instant foresight. Good risk management uses volatility as a guide, with judgment layered on top. Section 3. Diversification. With position sizing and volatility control in place, the next layer of risk management is diversification. Diversification spreads exposure across holdings that do not all respond the same way at the same time. The aim is not to eliminate losses, but to avoid making the entire portfolio depend on one asset, one theme, or one economic outcome. A concentrated portfolio can rise quickly when that one exposure works, but it can also suffer sharp damage when it does not. A diversified portfolio usually behaves more smoothly because different holdings can offset one another. What matters most is how the holdings behave together, not just how many of them you own. Diversification mainly helps with what is called unsystematic risk. That is the kind of risk tied to a specific company, sector, or asset, such as a product failure, regulatory change, or industry downturn. By holding different types of assets, you reduce the damage that any single problem can do. But diversification cannot remove systematic risk, which is the broad market risk that affects many assets at once. Recessions, inflation shocks, and periods of financial stress can hit large parts of the market together. So diversification is powerful, but it is not a shield against everything. The reason diversification works is correlation. Correlation describes how two assets tend to move relative to each other. A correlation near +1 means they usually move together, so combining them gives limited diversification benefit. A correlation near 0 means there is no strong, consistent relationship. A correlation near -1 means they tend to move in opposite directions, which can provide the strongest offset. In practice, assets with low or modest correlation are often the most useful additions because they can change the overall behavior of the portfolio. This is why simply owning more holdings does not guarantee better diversification. You can own 20 names and still be highly concentrated if they all depend on the same risk drivers. For example, a portfolio full of similar technology companies may look diversified on the surface, but it can still move as one when that sector comes under pressure. On the other hand, a smaller set of assets with different economic drivers may create a more resilient mix. The right question is not how many holdings you have. The right question is whether a new holding changes the portfolio's behavior in a meaningful way. A practical diversification process starts with the portfolio you already have. First, identify where the concentration sits, whether by sector, geography, style, or asset class. Then examine possible additions and ask how correlated they have been with your current holdings. Lower correlations, often below about 0. 3. Can be especially helpful, though that is a guideline rather than a rule. After that, evaluate the whole portfolio again, because diversification is a portfolio-level property, not a feature of one investment in isolation. And keep monitoring, since correlations can change over time and especially during stressed markets. Diversification has clear benefits, but those benefits are not unlimited. The first few genuinely different holdings often reduce risk the most, because they remove the most obvious concentration. After that, each additional asset tends to help less. Many investors find that once they have roughly 10 to 15 reasonably uncorrelated holdings, the extra benefit begins to flatten out. Beyond that point, more positions can add fees, overlap, and complexity without much additional protection. It is also worth remembering that diversification does not guarantee gains. And in severe market stress, assets that usually behave differently can start falling together. Consider a simple example of concentration risk. If a portfolio is 100% invested in a US technology ETF like VGT, its fortunes are tightly tied to one sector. If that sector struggles, the whole portfolio suffers. Relocating to a mix such as 50% VGT, 25% bonds, 15% infrastructure, and 10% commodities introduces exposures with different drivers. Because those assets tend to have low to modest correlations with one another, the overall portfolio becomes less dependent on technology alone. In the example, estimated volatility falls from about 20% to about 12%. The point is not that returns are guaranteed to improve, but that risk becomes less concentrated. A good way to practice diversification is to build a small model portfolio and focus on weights and correlations, not just names. Imagine a $50,000 portfolio with 3 assets and assigned initial weights to each. Then estimate how closely those assets tend to move together. After that, add a 4th asset whose correlation with the others is below about 0.3, and give it a 20% weight by reducing the original positions. The exercise helps you see whether the new asset actually changes the portfolio's risk profile. That is the habit to build. Count relationships, not just positions. Many diversification mistakes come from confusing appearance with reality. Owning many securities with the same underlying risk drivers is still concentration, even if the portfolio looks broad. Another common mistake is assuming correlations stay stable, when in fact they often rise during stressful periods. Some investors also over-diversify, adding more and more holdings long after the main benefit has already been captured. And perhaps the biggest misconception is believing diversification protects against all losses. It reduces specific risk, but it does not eliminate broad market drawdowns or the need for sound allocation and risk control. Section 4. Portfolio Allocation. Diversification asks how holdings behave together, and portfolio allocation steps back even further to decide how much capital belongs in each major asset class. Allocation is the overall blueprint of the portfolio. It determines how much goes to stocks, bonds, cash, digital assets, or other categories. That matters because asset class exposure often drives portfolio behavior more than any single holding inside those buckets. Owning many stocks can diversify stock-specific risk, but it does not answer how much of the whole portfolio should be in stocks in the first place. Allocation is what sets that bigger balance between growth, stability, liquidity, and risk. Mixing asset classes matters because they tend to respond differently to economic conditions. Stocks may offer stronger growth potential, but they can also fall sharply in downturns. Bonds often provide more stability, especially in periods of weaker growth or falling rates, though not in every environment. Cash offers liquidity and flexibility, but usually with lower return potential. Real assets such as commodities or infrastructure may respond differently to inflation. By combining assets that do not all move the same way, investors can often reduce total portfolio volatility. A thoughtful allocation aims for a better trade-off between risk and expected return. Instead of concentrating in whichever asset has recently performed best, it combines assets with different return drivers. That can lower portfolio volatility and sometimes preserve expected return more effectively than a narrow portfolio can. This idea connects to the efficient frontier, which is the notion that some combinations of assets are simply more efficient than others for a given level of risk. You do not need complex math to use the concept. The key message is that a better mix can sometimes achieve a similar goal with less turbulence along the way. The most suitable allocation usually comes from personal constraints, not short-term market forecasts. Your time horizon matters because longer horizons give more time to recover from declines. Your risk tolerance matters because the best allocation on paper is useless if losses will cause you to abandon it. Liquidity needs matter because money needed soon should generally not be exposed to large swings. Income needs matter as well, since some investors depend on steady cash flow from the portfolio. In other words, your circumstances should shape the mix more than your latest market opinion. Most investors benefit from separating strategic allocation from tactical allocation. Strategic allocation is the long-term target mix that reflects goals, constraints, and risk tolerance. Rebalancing helps keep that structure in place as markets move. Tactical allocation is different. It involves temporary shifts based on shorter-term views or opportunities. That can sometimes add value, but it also introduces more judgment, more monitoring, and more room for error. For many investors, the strategic plan should do most of the work while tactical changes remain limited and disciplined. A practical allocation process begins with defining goals and constraints clearly. Once that foundation is set, choose the broad asset classes you want in the portfolio. Then assign target percentages to each based on the role they play in growth, defense, income, or liquidity. After that, implement the plan as simply as possible, often with diversified and low-cost funds. Simplicity matters because a portfolio that is easy to understand is easier to maintain. Historical data can help provide context, but the goal is not to chase the assets that have most recently done well. Once an allocation is in place, market movements will naturally cause drift. Assets that perform strongly become a larger share of the portfolio, while weaker assets shrink as a share. Over time, this changes the portfolio's risk profile, sometimes without the investor realizing it. Rebalancing is the process of selling part of what has become overweight and buying what has become underweight. That may feel counterintuitive in the moment, but it is a form of risk control, not a market prediction. It restores the portfolio to the level of risk you originally intended. Consider a portfolio that begins at 50% stocks, 40% bonds, and 10% cash on $100,000. After 1 year, suppose stocks rise to $55,000, bonds fall to $38,000, and cash stays at $10,000. The total portfolio is now $103,000. Without making any trades, the weights have shifted to about 53. 4% stocks, 36, 9% bonds, and 97% cash. The portfolio is no longer at its intended mix. This is exactly the kind of quiet drift that rebalancing is meant to correct. At the new total value of 103 world hours dollars, the original 50-40 AS10 target becomes 51,500 in stocks, 41,200 in bonds, and 10,300 in cash. Since stocks are at 55,000, you would sell 3,500 of stocks. Bonds are below target, so you would buy 3,500 of stocks. Bonds are below target, so you would buy 3,200 of bonds. Cash is also below target, so 300 would be added there. After those moves, the portfolio is back to its intended structure. The key idea is simple. Trim what grew above target and add to what fell below target. Even a sensible allocation can fail if it is managed poorly. One common mistake is skipping rebalancing and letting the portfolio drift into a riskier shape than intended. Another is chasing recent winners, which often means adding exposure after strong performance instead of following a plan. Portfolios can also become unnecessarily complex, making them harder to monitor and easier to mismanage. Investors sometimes forget practical issues too, such as liquidity needs or the fact that correlations can change. And when allocation turns into constant market timing, discipline usually gives way to emotion. Section 5. Managing drawdowns. All of these earlier tools ultimately point toward one practical question. How bad can the decline get before the portfolio recovers? That is what drawdown measures. A drawdown is the percentage drop from a recent peak to a subsequent low point. It is not just day-to-day volatility, and it does not end simply because prices bounce a little. The drawdown ends only when the portfolio climbs back to the prior peak. This makes drawdown a very useful way to think about the investor experience of loss, because it captures both magnitude and context. Drawdowns matter because losses do not recover in a straight, symmetric way. A 10% loss needs an 1% gain just to get back to even. A 20% loss needs 25%. A 50% loss needs a full 100% gain. The deeper the decline, the harder the recovery becomes because you are trying to rebuild from a smaller base. That is why limiting drawdown depth is so important. Preserving capital improves your ability to recover when conditions eventually improve. Not every decline is dangerous. Short-term pullbacks are a normal part of investing, and many strong strategies experience regular dips along the way. The bigger concern is a drawdown that is too deep, takes too long to recover, or becomes emotionally difficult to tolerate. A manageable decline may leave your plan intact, A severe drawdown can push an investor into panic selling, revenge trading, or abandoning a sound process at exactly the wrong moment. So when you evaluate drawdowns, you are judging not only the mathematics, but also whether the loss is financially and psychologically manageable. Drawdowns can come from several different sources. Sometimes the cause is broad market weakness, where many assets fall together. Sometimes it is more specific, such as a decline in one sector or theme. Portfolio construction matters too, because concentrated positions can turn a normal setback into a major hit. Poor entry timing can worsen the experience by placing capital near a local high before a decline. And leverage or oversized trades can magnify all of these effects, turning an ordinary loss into a damaging drawdown. Two numbers are especially important when tracking drawdowns: depth and recovery time. Maximum drawdown tells you how far the portfolio fell from peak to trough. Recovery time tells you how long it took to regain the prior peak. Those two measures work together. A 15% decline that recovers in 2 months is a very different experience from the same 15% decline that takes 2 years to repair. Looking at depth alone can miss that distinction. Long recovery periods often signal fragility, even when the decline itself does not look extreme. The basic drawdown calculation is simple. Start by identifying the highest portfolio value over the period you are measuring. Then compare that peak with the current value, or with the trough if you are analyzing the worst point of the decline. The formula is peak minus current, divided by peak. For example, if a portfolio falls from $123.00 to $93.00, the drop is $33.00. Divide 1300 by $123.00 and you get a 25% drawdown. Drawdown rules work best when they are created before emotions are involved. Decide in advance what thresholds matter to you and what each threshold will trigger. For example, a 10% drawdown might mean review the thesis, check sizing, and reassess liquidity. A 20% drawdown might call for reducing risk, trimming positions, or rebalancing more defensively. The rule should fit your tolerance and your strategy. If thresholds are too tight, you may trade constantly. If they are too loose, you may absorb more damage than intended. A drawdown response should support disciplined action rather than panic. Depending on the strategy, that may mean reducing position sizes, trimming concentrated holdings, or raising some cash. In some cases, it can also mean pausing new trades temporarily until conditions stabilize. More advanced investors may use hedges when they are appropriate and well understood. The value of a rule-based response is that it preserves flexibility under stress. Specific actions are much easier to follow than vague intentions when the portfolio is under pressure. Consider a simple example of limiting further damage. A portfolio falls from a peak of $120.00 to a trough of $90.00, which is a 25% drawdown. From $90.00, it now needs a $33.30, 3% gain to recover back to $120.00. Suppose one investor stays fully invested and then suffers another 10% decline in equities, taking the portfolio down to $81.00. Another investor moves $15,000 to cash at the trough. So when equities fall another 10%, the portfolio ends at $82,500 instead. That defensive move preserved $500, which does not guarantee better returns, but it does reduce the depth of the hole that must be climbed out of. Managing drawdowns is not a one-time decision. It is an ongoing review process. After a significant decline, study what caused it. Was it market-wide stress, concentration, leverage, oversized positions, or a rule that was too loose? Avoid the temptation to chase losses in an effort to get back to even quickly, because that often increases damage. Track maximum drawdown and recovery time, not just average losses, and use what you learn to refine position sizing, diversification, and allocation rules. The goal is not perfection. The goal is a process that makes future drawdowns smaller, shorter, and easier to survive.